Good morning.
Hello.
So we've got two case studies to talk about. One of them is currently underway in the portfolio. Another one is completed. As Emma mentioned, they talked about it last year, so it's a bit of a part two, final instalment of that. It's on the screen already. You're there already. So the first one is US Masters Residential Property Fund, or to go by the ticker, URF. Now this has got some history to it. I didn't want to spend too much time covering that. I wanted to focus on why it's become a meaningful investment in the portfolio today. Now, for those that don't know this, URF is a trust listed here in Australia that owns single-family residential property in New York and New Jersey. Essentially, this is a REIT. It was launched years ago at $1, traded well initially, then went to a deep discount, which is where we turned up on the register. Now today, URF trades on a discount of 37% to asset backing. However, the shares have actually done pretty well this year. This had been trading at around half of the value of the assets at the end of last year. Now, when a fund trades on a discount of that level, the first question you ask yourself is, how accurate are the asset values? Now, in the case of URF, they sold over $200 million worth of assets between 2019 and 2022. They've then sold another $150 million worth of assets since early 2023. And before costs, those sales have been remarkably close to the carrying values. The issue URF has is negative cash flow. The yield on the portfolio is very low, and on its own is not enough to pay the interest on the debt and the company's running costs. So the key consideration is therefore, how do you get this substantial value out of the company as quickly as possible and back to us shareholders? And for that, you need the right incentives in place and the right governance arrangements. And that's something that the board and key shareholders, such as GVF, have been focused on. As such, the fund today is in wind down. You have a manager that's got all the right incentives to sell assets as quickly as possible, whilst also maximising value. And you have a board that's completely accountable to shareholders. I don't have a chart here, I'm afraid, of the share price, but if you looked at the share price for some time, it went nowhere. In US dollar terms, which is the way you should think about this, the share price just went sideways for quite a while, and it was difficult to see any improvement. Now, the chart on the bottom left here shows monthly asset sales since they resumed in January 2023. As you can see, they took a while to get going. However, they've really accelerated this year, and particularly in the last few months. Which brings us to the chart on the bottom right here, which shows you that even while the majority of that cash has been used to repay debt and to fund buybacks, you still have cash that's built up, equivalent to about 30% of the current share price. About 15% of the current share price is represented by cash that is truly surplus, and that could be paid out tomorrow. The reason it hasn't been paid out yet is because the fund is currently doing a review of how it repatriates cash from the United States in the most tax-efficient way possible. Now, we never assume any saving. We're just assuming we're going to pay the full whack on tax. But the dotted red line here gives you a sense of that additional upside if they manage to crack that puzzle. Mm-hmm. So this is, this isn't a new story we're bringing to you today. We've talked about it in previous commentaries. We also own different instruments further up the capital structure in the past. However, it is one where we feel like things are finally starting to happen, and we're feeling pretty positive about this going forward.
I'm like a peanut gallery. Can I just quickly step in? So just quickly on this one, to give you a sense of the life cycle of the trade that I was referring to earlier in terms of the strategy that we run. This was a product launched by Dixons, which you guys will all have remembered from the press. At the time, it was a fantastic product. It was a product of, let's offer Australian investors access to US real estate. We all love property. It was at a time where the Aussie dollar was above parity with the US dollar. Good product. Governance at Dixons, not so good. We all know the story. This was the poster child of Dixon's clients kind of running away from a terrible situation. As those clients were running away, we are the type of investor that runs towards, looks at, are these assets still good? do they still make sense? And if so, can we get involved and not only benefit from the underlying assets that we've purchased, those US, New York, Manhattan real estate, benefit from that, but also benefit from getting this product back up to parity. And that Mark has really underplayed what him and the team have done. They were the ones who put this into liquidation. They were the ones who fought off corporate raiders who try to come in and steal some of the assets. You know, it really has been a hands-on project where we've gone in there, advocated for shareholders, obviously our own shareholders, and then turned it around. It's still a work in progress. We're still selling off those properties, but ultimately this is the type of trade that illustrates what we do.
So that's one we can come back and revisit in the future, and you can see how accurate we were.